Hi, good afternoon and welcome to the third installment of the First Citizens Asset Management Limited 6 Steps to Financial Freedom program. Again, I am Nadira Prasad, the Senior Marketing Officer at First Citizens Asset Management Limited, and I will be your facilitator for today's webinar. Just to recap, the aim of this 6-session program is to build investor confidence through a series of financial literacy webinars, which shall encompass both savings as well as investments. The program is not designed to sell the products of First Citizens, but rather it was created to educate and inform the public of the need to take control of their own finances. First Citizens Asset Management Limited started its financial literacy drive in 2005 through hosting a series of seminars throughout Trinidad and Tobago, and the program has grown to now include personal meetings with corporations and now the newest edition, financial webinars. In session 1, for those of you who were with me then, we discussed the fundamentals of savings and investments. 2 weeks ago in session 2, we focused on understanding risks, and today's webinar looks at financial planning by life stages. Today's webinar will be 30 minutes in length with 20 minutes presentation time and 10 minutes to answer any questions submitted. To submit questions, please type it into the question window in your control panel. This can be seen to the right of the viewing window. If you do not see your control panel, please click on the red arrow to expand. Questions will be addressed at the end of the session. 2 polls will be conducted during this webinar. After selecting your poll choice, I ask that you please keep your viewing panel open. This webinar is for informational purposes only. The investments mentioned may not be suitable for all investors. Please be advised that all investments do involve some degree of risk. When making any decision, you need to take your own financial situations and risk tolerance into consideration. Before making any investment, you are advised to read a prospectus. And now to today's webinar. At the end of today's webinar, you will be able to identify which stage of life you're in, identify the financial goals facing you, not only financial goals, but expenses facing you during this stage. You will be able to assign a timeline and a value to your goals. And today's session, as I said, it focuses on all life stages and the goals, and I will also be giving financial tips that may be useful during each stage. Planning by life stages. 4 basic stages of life. There are some who use 7 stages, but we're going to look at just the 4 basic stages of life: the foundation years, accumulation years, preservation years, and the golden years. Due to our time constraint, the golden years will not be discussed in today's session, but it will be discussed later when we have a session entirely on retirement planning and post-retirement planning. What I'd like to say is that I did not assign ages to the stages in life, because what we found is that you cannot class the stages by age. You may meet a 19-year-old and a 30-year-old who are both at the same stage in life, because we've found that recently some people fresh out of school decide to start a career, start a family, get their studies finished within a 5-7 year period, whereas there are some persons who say, I'm going to take a few years, 5 to 10 years, find myself, decide what it is I want to do, and then they enter into the new career path and so on. So the first stage we're going to look at is the foundation years. In the foundation years, some of the major expenses that you will be exposing yourself to: education. Student loans. For those who don't take loans, education is still very costly if you decide to pursue degrees that are offered by universities and colleges abroad. Yes, right now we do appreciate that we have GATE and we don't have to pay for tuition for local degrees and local programs, but you cannot assume that this will always be available to the public. In foundation years, you also have car loans. This is the stage where you're purchasing your first vehicle. Mortgage, you're also saving towards the purchase of your first home. And if you have your own home and you decide to move on and be independent of your parents, you are now facing utilities and household costs. So some of the tips that I give for the foundation years, and generally that you would hear from most financial advisors or workers in financial institutions. At this stage, you would like to avoid credit card debt and consumer debt as much as possible. In this stage, the foundation years, this is where you're now starting your career. You're now starting possibly a family life. You're still studying or pursuing and finishing your studies. So the first thing you want to do is try to build some capital for yourself. We've said that you have expenses such as car loans. You want to save towards the purchase of a home and so on. So you're going to be focusing more on building your savings rather than increasing your liabilities. Credit card debt is one of the most serious debts that we try to advise younger persons not to get themselves too involved in, because once it is you find that you get deeply into credit card debt, it's very difficult to get out of it. And if you all are not aware, the interest rates attached to credit cards tend to be the highest interest rates. They are higher than your regular consumer loans. And what it is I normally advise the younger clients, or the clients who are now starting their lives off, is to do a balance sheet. So you have a clear picture of your assets and you have a clear picture of your liabilities, because at this stage you do not want to get yourself into a negative net worth. Because as we said, if you're looking for car loans, you're looking for mortgages, one of the things that a bank or any financial or lending institution is going to look at is your own personal financial statement, which gives them a clear view of where you stand and what your net worth would be. And if it is you get into the habit of taking credit cards and get into the habit of always spending more than you earn, or taking consumer debts for purchases that aren't necessary, on your balance sheet you will see that your liabilities are increasing and your assets may not be decreasing at the same value. Because even if you purchase a car valued at $200,000 and you took a loan for that $200,000 plus the insurance attached to it, from the moment you drive the car out of the showroom, it has depreciated in value. So on your liability side, you still have the loan for $200,000 plus all of the interest. And on your asset side, you now have to devalue that car, because it's now no longer worth that $200,000. So again, that will put you in a negative position if you didn't already have other assets on your balance sheet. So we try to say to avoid credit card and consumer debt as much as possible. If it is you are making a decision to have consumer debt and credit card debt, we ask that you look at how it's going to affect your financial position. Not only how it's going to affect your balance sheet, but how it's also going to affect your cash flow, how it's going to affect your debt service ratio. We advise that not more than 30 to 35% of your salary should be going towards payments of loans. The second tip I have for the foundation years, take advantage of compounding interest. The younger you are, the more your money can work for you with these investments. If it is you have an investment with monthly compounding interest and you have it for age 25 to age 50, and what we like to look at really is your retirement plans, because in your foundation years, I did not mention it under one of your expenses, but you should ideally start your retirement planning from as early as you start your new career or first career. So one of the things we ask is that you take advantage of compounding interest. If you find a product that gives you monthly compounding interest over a 25-year period, depending on what rates of interest are declared, the interest that you earn can actually exceed how much it is you contributed. For example, with deferred annuity plans in the commercial banks, if it is you're contributing, say, $100 every month for a period of years, if it is you go for as much as 25 years and so on, and altogether you contributed $200,000. With that compounding effect over such a long period, the interest that you earned may actually exceed how much it is you contributed. So you may have contributed $200,000, the interest earned may actually be $225,000, so that the full amount that you have accumulated could be very well $425,000. Whereas someone who started taking advantage of compounding interest later on in life would not have been able to benefit as much, because the advantage of compounding interest is that the longer you leave it in that sort of account or sort of product, the more it will benefit you. Manage your cash flow. What it is we try to say is that if you get into the habit of having a budget from a younger age, the easier your life would be later on. If it is you start managing how your income is used from a younger age, you will get into the right habits, and you'll see that later on when we speak about what it is you should be doing in the other stages. Once you develop the right habits from the foundation years, everything becomes easier as you move to the other stages in life. So if it is you have a budget, you state clearly what all your sources of income are. You state clearly what all of your expenses are. And when we say expenses, we don't mean only the expenses such as groceries, utilities, credit card bills, loan payments. You need to start including expenses such as entertainment, travel. Do you purchase lunch every day? And you try to stick to it. You need to manage your cash flow so that if you assign a value, for example, I tell a lot of the younger clients, if you tell yourself you're only going to spend $1,000 a month on entertainment, and in one weekend you spend that $1,000, you need to find some other way to entertain yourself for the next 3 weekends. Because if it is you then overspend in that area, it affects your expenditure that you budgeted for other areas. So something may happen during the month where it is you need access to extra cash, but because you went over budget in a certain area, you find yourself short and you find yourself living from salary to salary without being able to save and without being able to start a retirement plan, without being able to start savings towards the purchase of your own home, and you find yourself stuck in a rut. And then it is you come to the bank tells you you don't have enough of a savings pattern for them to give you a credit facility. And that is why we say, let us see what we can do with your budget, help you manage your cash flow, and then put you in the right position to help you build your future. Establish an emergency fund for 3 to 6 months living expenses. This 3 to 6 months is what is normally advised. However, it really depends on your own person and your own circumstances. What it is I tend to say is that if you have a job where you know you're very marketable, and if it is you are unemployed at one point and you know it will probably take you 3 to 6 months to find a replacement employment, that is fine. If it is you know you're in an area where it may take you up to a year or even more to find a new job or a new opportunity or start a new career path, maybe study something else and then get started again, we advise that your emergency fund should be up to 1 year's living expenses. And again, your living expenses can be easily identified from your cash flow. From the foundation years, we ask that you also look at life insurance. A lot of persons, because they don't have a family and don't have any dependents, think that it's not necessary for them to have life insurance. However, if it is you do intend to someday have a family, someday have a spouse, and someday have a kid, you want to ensure that the necessary steps are put in place to protect them. And life insurance tends to be cheaper at a younger age. If you think about it, guys, how much damage could the alcohol and the cigarettes could have really done to your body at age 22 as opposed to age 32? So we normally advise that the younger you are, you see about getting your life insurance as well as health insurance and disability insurance, because premiums tend to be lower from a younger age. And I know that I get a lot of younger clients who say, I'm not going to need that. I haven't seen a doctor in 5 years, or I haven't seen my dentist since primary school. You never know. Insurance is there to protect the risk of the unexpected happening. Death is expected. However, medical insurance, it's there to protect you against a risk that something may happen. You never know when you may be in a car accident, or there may be an accident at work or something. You never know when something can happen. And the cost, if you decide to go and get treatment privately in Trinidad and Tobago rather than be put on a waiting list, it is very costly. And I often use my own self as an example with clients. I never thought I needed medical insurance. And at the age of 24, I got into my first car accident and I walked out with just scratches. However, within a 1-year period, I needed 4 surgeries. And thank God I was convinced that same year to take medical insurance, and I had to pay not a single cent. So you never know what can happen to you. And now it's time for our first poll. I hope I didn't scare anyone away by speaking about the need for medical insurance, but we're also going to discuss other aspects of finance as well. But the first poll I'm throwing out to you guys: which financial institution do you prefer for credit facilities? Please send First Citizens or RBC Royal Bank or Republic Bank Limited or Scotiabank Trinidad and Tobago Limited. Again, which financial institution do you prefer for credit facilities? And moving on to the accumulation years. Again, we have not assigned any ages to this, but after covering the basics, which we just mentioned, you purchased your own vehicle, you purchased your own home, or you're ready to purchase your own home, you've already started your career path, you may or may not have started a family. So after covering the basics, the following needs to be completed before beginning the wealth accumulation process. You should have already accomplished your major purchases, which is what we just mentioned: family vehicles, family home, repayment of short-term debts, all your short-term loans, car loans. Yes, a credit card is a revolving credit facility, so we would not include that here. But any vacation loans, study loans that you may have had, those should have been covered before you start the wealth accumulation process, because financially, do you want to be paying loans with an interest rate of 10, 11%, where it is you have an investment portfolio that's earning you 6%? So basically, the spread between what you're paying and you're earning is 5%. So what we advise is that if it is you have enough funds to start a wealth accumulation process, the first thing we want to do is see how we can funnel those funds towards paying off your short-term debts, starting with the ones with the highest interest rates. And then when it is, if it is, we can decrease the spread between your investment portfolio and your credit portfolio, then it is we'll funnel some more funds towards your wealth accumulation. We also advise that you build up your emergency savings before starting wealth accumulation. Normally with wealth accumulation, you tend to go towards medium to long-term investments. I hate to have clients call me and say, Ms. Prasad, I have an emergency and I need to access funds from my Elder Coach fixed income fund, and I then have to inform them, well, because it's the first year of your investment, if it is you need to access it, I need to charge you a 2.5% penalty on the amount you want to redeem. So the first thing we ever tell clients before they start any sort of medium to long-term investment program is have your emergency savings, because you do not want to have to pay penalty charges or suffer from decreased returns on your investments simply because of an emergency. Financial plans to put in place during these years. In these years, you need to expand your investment horizon to include stocks, bonds, and mutual funds that facilitate these investments. One of the major things you're accumulating your funds to in these years is retirement. Basically, from the time you start working until you retire, one of the investments that you would have throughout is your retirement planning. And one of the things that you want from a retirement portfolio is a hedge against inflation, because you need to know that whatever amount you are saving will be able to continue to give you the lifestyle that you want at retirement. So in order to get these returns, you now need to expand your investment horizon to include stocks, bonds, and mutual funds that facilitate these, because if you were to leave it simply in mutual funds that simply have treasury bills, certificates of deposits, or you stick to a portfolio that has only deposit products, you would find that you are not beating inflation risk. Your portfolio would be opened entirely to inflation risk, meaning that the growth on your investments is negative if you were to take inflation into consideration. So one of the things we tell you in the accumulation years when you start your wealth accumulation process is that you need to open up your risk appetite. Yes, you may not be comfortable with it, but in order to satisfy certain goals in life, you will need to open up your risk appetite. We also advise that you establish saving plans for the education of your children. You don't want to wait until your child is 15, 16 years old and then you say, oh my God, she has potential. Maybe I should send her off to a university. What you need to do, and if you think about it, if you start saving as little as $50 a month from the birth of your child until they're 18, you would have accumulated enough for a tertiary education for that child. If it is, you can even increase it depending on what it is you think that your child wants to do and so on when they're 8, 10 and so on, and you see what it is they would like to do and it may cost more, you can even put $100 a month. But if it is you start from when they're born or from birth or from as little as 2 years old, you just need to put aside as little as $50, $100 a month. Whereas if you decided to save from the time they're 15 and they're graduating from secondary school at age 18, it gives you a 3-year period to accumulate sums as large as $30,000, $40,000 if they want to study abroad or if they want to go into certain fields. So we advise that you establish savings plans for the education of your children. In this stage, you should also be looking at making extra payments to one of your mortgage. One of the largest credit facilities you will ever have in your entire lifetime will be the purchase of your home. You may have purchased a home valued simply at $1 million. You may have taken a 25-year mortgage when you borrowed that $1 million. But if you look at your repayment amount, that is the principal plus the interest, it can be anywhere from 1.8 million to 1.9 or even 2, depending on what rate you were given. So what you need to find out when it is you're taking a mortgage is, can you make lump sum payments? And how often can you make lump sum payments? What you can also find out is, does the institution offer bi-weekly mortgages? Can you make the difference between a bi-weekly and a fortnightly? Fortnightly is where you make 2 payments a month. A bi-weekly, you make a payment every 2 weeks, which means you'll be making 26 payments instead of 24 payments for the year, which means that there will be 2 months within the year where you are required to make 3 payments. If it is you can facilitate that sort of payment plan, and the institution does offer it, and you can't ask them to calculate the difference that you'll be paying back at the end of your mortgages, you may see that you may save as much as $200,000, $300,000 on a $1 million mortgage. So you need to find out all of these things about your credit facility. You need to also review your life insurance policy. Additional coverage may be required and riders may be purchased. At this point in time, as I said, you may have started a family life. In your younger years, you may have taken out life insurance policy for yourself. Now you may have a spouse and 2 or 3 kids. You may want to add policies for those persons in your life. You might want to put extra things in place. If it is you thought that when you were younger, a life insurance policy for $1 million may have been sufficient, but now that you have 4 dependents, you may say, maybe I need to increase it to $1.5 million, maybe even $2 million. So you need to review your life insurance policy. You also need to review your medical policies, because as you get older, one thing you should look at is your own health and see what it is you're prone to, and see if it is you can take additional coverage for certain things that you think you may be susceptible to later on. Take advantage of investments that allow for tax deductions, or investments which allow for income to accumulate on a tax-deferred basis. In your accumulation years tends to be some of the peak earning years for you as well. One of the things I'd ask you to look at on your payslip is your PAYE. If there are ways for you to reduce your PAYE, we will advise that you take advantage of it. For example, with deferred annuity products, for every $100 contributed to an approved deferred annuity product, your PAYE is reduced by $25 because our tax rate is currently at 25%. So if it is you contribute $100, you save $100 towards retirement, and you reduce your PAYE, which means you increase your disposable income. So these are things you need to look at, because with deferred annuities and so on, you can claim up to $30,000. That $30,000 is inclusive of all contributions to approved pension plans, approved deferred annuities, as well as 70% of your NIS contributions. So you need to look at ways to reduce your taxes within your accumulation years. And now it's time for the second poll of today's webinar. The question I am asking you: which financial institution is your preference for investment products? I will ask that you please send First Citizens Asset Management Limited, or Unit Trust, RBC Royal Bank, Republic Bank, or Scotiabank, Trinidad and Tobago Limited? Again, which financial institution is your preference for investment products? And moving on, the final stage that we're going to be looking at today is the preservation years. By this stage, you should have covered most of your financial goals. Some of the expenses you now incur, your preservation years is usually about 5 years pre the retirement age that you have decided for yourself. Unfortunately, some of us are not, we cannot decide what retirement age we would like, and we have to work as late into life as possible. But if you're fortunate enough to be able to decide at what age you would like to retire, and if it is you've taken some of the advice and some of the tips that we had from the previous stages, you might be able to. You should have covered most of your financial goals by this period. It's only 5 years pre-retirement. And some of the expenses you might now want to face is if you want to purchase a second home or vacation home. It could be that the kids, are getting older and so on. You may see that you don't need a big house anymore. You can decide on a second home, which may be a smaller home just for you and your spouse and whichever younger kids you may still have. And you may want to actually sell the larger one. You may now want to provide assistance to your children or grandchildren in their lives. And one of the more, it may be listed third here, but the most important thing in your preservation years is the topping up of your retirement plan. This is the point where you need to look at what you already have in place for retirement, see if you're falling short in that. Financial tips during these years. You need to revisit your medical plans to ensure coverage for long-term illness and care. A lot of us don't think about this when we're younger, but as you get older, by the time you reach that age, you'd realize that one of the people you're on a first-name basis with is your doctor. You may be seeing your doctor more frequently than you see some family members. So revisiting your medical plans to ensure coverage for long-term illness and care is very important, because medical coverage with the company for which you work may not extend beyond retirement. So at this point, you want to ensure that it is you have enough coverage so that when you retire, you do not have to worry about these additional costs. You may now want to review payment options at retirement, the plans available, as well as the payout of tax-free lump sums. At this point, you're now going to get a listing of all aspects of your retirement portfolio. If you have more than one deferred annuity plan, you want to find out with your own company pension plan, hey, can you give me an idea of what my pension will be at retirement, what it is your gratuity will be. You want to call the different commercial banks or the different insurance companies that you have these plans with and find out what the lump sum options are and what the payout options are, because a lot of time I will advise that you take the lump sum rather than put in 100% towards a pension plan, because that lump sum can then be used towards an investment plan that can also provide income. And if it is you use the lump sum towards an investment plan that provides income for you, you still have that lump sum holding in a fund while income is being paid. Whereas if the entire amount is put towards a pension plan, if it is you have an emergency where you need access to more funds, you can't go to the insurance company and say, you know what, I gave you a lump sum of $1 million for a pension plan, but could I get like $200,000 from it because I have a medical emergency and you wouldn't be able to pay me a pension for a while. It doesn't work that way. However, if it is you had put part of your lump sum in an investment, whereas you were getting monthly income or quarterly income and so on, if the need did arise to get access to that lump sum, it would be possible. So these are the things you need to review in the preservation years, all the options that are available to you and what options you may need to pursue. You also need to start moving your investments to lower risk instruments. Yes, in the accumulation years, we spoke about exposing yourself to equities and bonds and mutual funds. That gives you exposure to both. But at this point, you want to now take lower risk levels with your investments, because at retirement, you want to know that there's preservation of capital. 5 years before retirement, if it is that your portfolio is 1.5 million, at retirement, you don't want to hear it's now worth 1.2 million. You would like to know that it's at least 1.5 or more. So what we advise is that in your preservation years, you start moving your investments to lower risk instruments and pay off debts. You do not want to go into retirement and into your golden years, and you do not want to have funds from your pension going towards paying consumer loans or going towards paying credit card debts. So one of the things that we advise is prior to retirement in your preservation years, you see about paying off debt and you avoid getting into new consumer debt. I know it has been a lot to absorb, and we will be discussing some of these in other sessions. And if it is you want further information, you can always give us a call or send us an email. At the end of all of our sessions, we feature one of the products of First Citizens Asset Management. The product for today is the Altacouch Fixed Income Fund. It is a medium to long-term investment product. It's a bond fund with investments in debt securities in the local, public, and private markets. There are no allowances for investments in equities, so you do not have to worry about exposure to the equity markets. If you're not comfortable with equities, but you are comfortable with bonds, this will be a product ideal for you. The one-year return on the Altacouch Fixed Income Fund as at July 31st, 2011 is 5.82. The Altacouch Fixed Income Fund was launched in 2008, October of 2008, and the cumulative returns from inception to the end of July is over 30%, giving it an annualized return of a little over 10%. Redemption charges apply within the first 2 years. As I said, it's a medium to long-term investment product, so if you do need to withdraw from the fund within the first 2 years, we have redemption charges, 2.5% in the first year, 1.5% on the first year. We charge you only on the amount that you are withdrawing from the product. To start the Altacouch Fixed Income Fund, it is 10,000 TT dollars. The Altacouch Fixed Income Fund has a fluctuating unit price, so for those of you who are looking for capital preservation, this may not be the product for you because your capital is affected as the unit price changes with this product. I know that I have gone over the 30-minute period. However, I will now be checking to see if we have any questions at this time. You can feel free to submit any questions that you may have. If it is your questions do not get answered, you may send an email to investments@firstcitizenstt.com. That goes to my entire department. An answer will be sent within a 24-hour period. Unfortunately, we seem to be getting some technical difficulties, but for those of you who do have questions, please feel free to submit it, and myself or one of the officers within my team will send you a response. I am seeing, why is first-year insurance so high for first-time owners of cars? Unfortunately, my area expertise is not insurance, but we can see if we can find out for you. But I know it's normally, they look at your years of experience in driving. So even if it is you have many years of experience in driving, for the purchase of your first car, it wouldn't be that bad. And I remember from my own experience that it's basically asked me if I was over or under 25. And because I was under 25 with limited driving experience, it was a very high rate. But when I crossed 25, it changed drastically. So I'm not sure if it has to do with your age or if it's just your first time purchase, but we will be able to find out for you and answer that question. Can these sessions be accessed at a later date? Yes, these sessions will be made available online to those who are interested. Unfortunately, not at this moment. It will probably be made online sometime during next month. And when it is, we will send a link to those who attended our sessions, and you may share it with persons who may be interested. I'm seeing, I'm not sure if this is an entire question, but you will need to get a loan that encompasses purchases, etc. Oh, this is tied to the question with the owners of cars. I think I will send your response to that personally, Tricia, because I'm not exactly sure what it is you're trying to ask. What is the best performing mutual fund on the market at this time? I can't say offhand which is the best in the Trinidad market. However, I do know that the best performing, well, the one as at the end of July, I can only speak as at the end of July, but the highest returns on the mutual funds within First Citizens Asset Management and probably within the commercial banks within Trinidad and Tobago may be the Immortal Income and Growth Fund, which was the featured product in our last session, whose one-year return as at the end of July has been over 7%. Are you expecting the Abercrombie Fund to pick up soon? Ms. Williams, the Abercrombie Fund has picked up. I am not sure if you're aware, but it has actually increased to 2.15% effective March 3rd of this year after being held at 1.9% for an extended period of time. So it has picked up. Credit cards may hamper getting loans, same mortgage, etc. A credit card has its pros and its cons. A credit card can actually help you in having a very good credit rating if you manage it properly. If you do not manage a credit card properly, it may actually give you a low credit rating, which will affect how banks view you before giving a credit facility. Our next session is actually entitled Crediting You and Managing Your Credit, and we are going to be looking at the pros and cons of credit cards, as well as when to get into consumer debt, how to plan towards getting a mortgage, and all of the aspects of credit in our next session, which is on September 7th at 1 p.m. Oh, it says, is it true that the higher credit limit on a credit card may hamper getting loans for, say, a mortgage, etc.? Yes, a higher credit card limit will, because what it is the banks will look at is your debt service ratio, and your debt service ratio includes your payments to all credit facilities. So if it is you have a higher credit card limit, your payment to your credit card will be higher. So therefore, if your credit card limit is higher, your payment, your required minimum payment will be higher and will be included when calculating your debt service ratio. So it will affect the amount that you will qualify for on a mortgage. Okay, I am seeing other questions, but unfortunately we are running out of time. So I thank you for being with me today. I thank for those of you who have been with me for the third time. And I hope to have you all again with me on September 7th, where we discuss credit and all aspects of credit. Thank you and have a good afternoon.